This is episode 133 of Zen and the Art of Real Estate Investing with my guest, Michael Zaransky. Michael is the founder and managing principal at MZ Capital Partners. They concentrate on investment property acquisition and development. Michael has been in it a long time. We were just chatting before. I'm really excited to have his experience on the show. Michael, welcome to the show.
Thank you, Jonathan. It's a pleasure to be here.
Yeah, it's a pleasure to talk to you. And like we were saying before, it's nice to talk to someone who's been through the cycles so we can help some people who are dealing with these newer cycles of real estate. But when was the first time that you got started in real estate? How old were you?
I got started right after I graduated law school. I never practiced law. So I was, no one asked me my age, 24 years old. So a long time ago.
Yeah. And what was the impetus to draw you towards real estate when you decided you weren't going to take the law license and use it as a traditional lawyer?
I really always was drawn to real estate. I grew up in a family of real estate entrepreneurs. My grandfather was in it. He was an immigrant to this country. He was in it all over Chicago. My dad dabbled in owning real estate as well. And I went to law school really for the business background. I never interviewed for law positions. I thought it would be a great background, and I kind of hit the ground running when I graduated.
Did you know, even when you were younger, like as a kid, was it interesting to you to see what your grandfather and your father were doing with real estate?
It was interesting. I remember sometimes on weekends taking rides with my dad and walking buildings.
Oh, me too.
Picking up applications, that were handwritten because, of course, there was no online application. And I was kind of drawn to it.
Yeah, I agree. I learned a lot pre-internet, for those of us who were operating back then, because it was just a little easier to be human to human at that time. There's a lot of things that you can put technology in the middle. How do you feel now compared to back then? Do you think it's gotten better or worse in general?
I think in general better.
Yeah,
You're better, but there are disadvantages. Things sometimes move too quick. I think the inclination that we all had was the internet was going to make our quality of life easier. It would free up time, but it's really turned us into having to work 24 hours a day, a week.
Yeah.
Especially when you factor in people in different time zones in the real estate business, either applying for apartments or trying to broker a deal. It's just, you're always on.
Yeah. And I mean, you've had your license as a broker since 1979, but do you remember what it used to be like? I try to tell people, because now everything's at their fingertips with Zillow. There used to just be books with one photo and paper you would go through to go see properties with your agent, right?
Totally remember. You'd wait for the book to come out.
Yeah.
And you kind of go through it and then meet at the property. And then not only that, actually, if you ended up buying it, actually ended up attending in person a closing with a cashier's check, sitting at the table with the seller and the lender oftentimes.
Yeah.
Then when you went to the point of having to find tenants, actually having to run an ad in what we used to call back then a newspaper.
Yeah.
On paper. And
absolutely.
Someone at the apartment in person and showing it to them and having them fill out an application to apply for the apartment, back to the office to figure.
Those were phone call employment verification and everything else. So it was a whole different story. When you moved to multifamily, did you go right to apartments or did you start with smaller versions?
Yeah, right to apartments, but smaller buildings. I bought a couple of 6 flats in the Chicago market. Chicago, he has kind of a standard style 6 flat with a center entrance and 3 units on each side, story walk up.
Yeah.
Got to know that product well. I bought them in emerging neighborhoods and was able to grow rents, keep them occupied, and eventually sell those and do tax-free exchanges into larger buildings.
Yeah, specific to Chicago, though, because you're talking about identifying emerging markets, that's still really a play in Chicago. It always has been. To be the best at real estate in Chicago, you have to be on top of where the markets are changing because it can be very close to different areas that
Yes.
you could get it wrong, right?
Yeah. I mean, I've since expanded our footprint nationally to other states. But what I learned from that early experience and still even in those markets, and I'm always reminded, is that real estate's a very local business. And just throwing out a name of a city just because it sounds great, like Austin or Nashville or Charlotte, doesn't mean very much unless you know neighborhood by neighborhood and almost block by block where you're buying and see the signs of what's emerging. Back
Yeah,
then, my quick test of an emerging market was if Starbucks located in the neighborhood.
yeah,
Doesn't work very much anymore because they're everywhere.
yeah.
Back then, they were kind of ahead of the curve on their demographics and market research.
Yeah, I still think that there's other companies that you can use now that are viable representations of emergence. But like, yeah, it went from there to Whole Foods to Trader Joe's.
Yeah,
At a time, I really liked Subway. I thought that Subway they almost seemed to never go out of business until the
yeah,
pandemic, and then we saw that happen. But that's interesting. Did you use those type of things though when you started to choose other markets outside of your main market in
yes,
Chicago?
absolutely. When got down to looking at buildings and learning about other markets before I actually had an acquisition there, I would go and drive and use those kinds of things like see if Starbucks is there, if Walgreens or CVS. Walgreens or CVS was on the same corner, kind of head to head.
Yeah,
That told me a lot about the area and growing. And of course, Trader Joe's and Whole Foods was a home run for demographics as well. It's
yeah.
interesting that you had a similar approach as an entrepreneur to let the bigger, larger firms with the massive research and demographers figure out for us
Yeah.
emerging.
As you started to scale up into larger properties, what did you decide to do else? Because I know at some point you're one thing I wanted to talk to you about is the differential now between building new versus buying existing structures and what you think about that. Because I think on a large scale, there's some pros and cons really for both.
Right. We started to evolve to the point where I was looking to do larger transactions as we built up our own equity as well as had outside investors approach us about providing equity and decided to start doing more deals of scale, larger communities. And I focused on larger complexes that could have a standalone management office and manager, leasing agent, and
Yeah.
maintenance person on staff, and started doing those deals. And then realized at different points in the cycle, um, when properties were selling at premiums, that uh, we often could build ground up at a lower all-in cost than an acquisition cost of a fully stabilized property. It involves some risk and having to be comfortable with the area, knowing that we can get to lease up because you basically start with zero income in a
Yeah.
empty property. And we successfully developed a number of properties in the Houston, Texas market, as well as the suburban Chicago market, as well as Knoxville, Tennessee. And we did a fair amount of development over the last 5 or 6 years. Um, and what I've noticed in the last year and a half or two, primarily because of the run up in interest rates and the cost of construction loans, as well as the cost of materials, that it again makes sense for our company, at least, to buy and acquire existing stabilized properties because we can buy them at below the cost of construction, below replacement cost. And that,
Yeah, and
that's,
like construction costs have gone up, and with all of the bad debt out there, some of those acquisition costs have gone down, even though there was a long time where sellers were just being
yeah.
unrealistic about what the multifamily market looked like for them, right?
Yes, I think product that's available on the market, a seller that is selling into this market, which is depressed because of the capital markets and interest rates, is someone making a decision that they need to sell for some reason, either a maturing floating rate loan,
Yeah.
an equity investor that wants out, something like that, and those properties are selling for less than what they would have sold for in 2018 to 2020.